The Fed is tightening into an economic slowdown, and that is bad for risk assets. We're discussing this with our next guest, Alfonso Peccatiello. He was formerly the fund manager of a $20 billion fund, primarily composed of fixed income assets, and now he is the author of the Macro Compass newsletter. Alfonso, it's your first time on Kitco. Welcome to the show.
My pleasure, David. I'm very happy to be here.
So, Alfonso, your first time at Kitco, so we'll go through the gamut of your macro research. But before we get into specific assets like gold, Bitcoin, and stocks, let's talk about your thesis. So the Fed is tightening into an economic slowdown. What do you mean by that?
What I mean is that the bond market is speaking very clearly, has been speaking very clearly since summer last year, David. And so the economy is going into a slowdown. The growth impulse has slowed down since the summer of last year. We're still growing, still above trend by a bit, but the impulse of this growth has slowed down. And the bond market is talking. The bond market is talking via the yield curve. The yield curve is flattening very aggressively. The spread between the 5-year and the 30-year part of the yield curve has flattened to very aggressive levels. And on a metric I track, it's actually inverted a few sessions ago.
So before we continue, let's break down the term yield curve and explain that to the audience who may not be familiar with this terminology. So the yield curve is essentially the difference between a long-term maturity bond yield and a short-term maturity bond yield. And economists use this as a gauge of whether or not an economic slowdown or economic growth is going to happen. Tell us how this works.
So let's talk about that. It's paramount important. So when I say the spread between 5-year yields and 30-year yields, why is that important? Because basically 5-year yields tend to indicate where monetary policy is going, right? That's the short term, the average cycle of a monetary policy tightening or easing is around about 5 years. 30 years, David and the audience, that is something else. That is a different beast. That is driven by the long-term possibilities, potential growth that the economy can generate. So we're talking about productivity, demographics, technology. We're talking about 30 years down the road. So we're talking about structural factors. And so when this yield curve inverts or tends to flatten, it means that the monetary policy is getting way too tight in the short term. And so that long bond traders are basically saying, if you tighten the monetary policy so much in the short term, in the long term, this will compound the structural problems the economy is facing. Unproductive debt, technology, demographics, productivity, which is very slow. Those are already strong headwinds for higher rates. If you tighten on top of that very aggressively in the front end, this will compound these problems. And so while the front end part of the yield curve goes up to reprice a more aggressive Federal Reserve, the long end of the yield curve actually remains stuck or goes down a bit. And so when it flattens like that, it's basically saying the monetary policy stance is becoming too tight.
Okay. So you're talking about a Fed tightening into a slowdown, which would be bad for risk assets. Which risk assets are you referring to?
So it's the broadest spectrum. If you ask me today, do you want to be invested in the stock market? There are some sectors where I might want to say it still looks okay. But overall, the stock market returns are basically driven by earnings growth, and valuations changes, right? So as we have a slowdown, and we can explain later why that is the case, the prospect for earnings down the road is not very rosy. And so then we have valuations. That's the other part of the equation. And if the Federal Reserve tightens monetary policy during a slowdown, then it brings up real interest rates in an unfriendly way. And what that does, it hits valuation. It doesn't allow valuation to continue rising. And so where are these stock market returns going to come from? If they don't come from earnings and they don't come from valuation changes, then where are they going to come from? Of course, every sector is different, but overall speaking, this is a market where to be a bit more defensive than usual. And then I can move the same assessment, David, as well to other asset classes like Bitcoin, for example, or to highly sensitive towards risk-taking asset classes, right? Bitcoin is one of those.
Yeah. We'll touch on Bitcoin and other assets in just a minute. Going back to your thesis, the Fed tightening, how do you know the Fed is going to tighten this year? They haven't yet tightened. There's speculation that they're going to do it. The market is pricing in a rate hike by March, which is not too far away. But again, nothing is for certain. How do you know they're going to tighten?
So basically, the Federal Reserve now faces a serious problem, which is it has a political incentive to try and bring American real wages up. So the wages of American people over the last year have shrunk by about 2 to 3% on a year-on-year basis. And that is reflected in the current polls of Biden. Obviously, if your wage adjusted for inflation is not going up, your purchasing power is not increasing. And therefore, your happiness as well and your ability to be able to vote for the same political leader is not there anymore. So the Federal Reserve is seeing these high levels of inflation and wages are rising, but not as much to catch up with these high levels of inflation. And so the incentive from the Federal Reserve is definitely to tame these inflationary pressures. The labor market is very tight, so wage growth is probably going to remain there. If inflation slows down, then real wages will go up, which is the agenda actually that we have behind. And so they are committed to that.
If they tighten into a slowdown, like you said, there is a risk that they will cause a recession very soon. And if they do that, the unemployment rate could go up. Remember, the Fed has dual mandates, the two mandates of containing inflation and also maximizing employment. So are they sacrificing one mandate for another by tightening, you think? They're in a very tight spot. I wrote on the Macro Compass an article in December. It talks about the gentle tightening that they need to engineer. It's a very difficult dance. It's an equilibrium dance where they need to tighten. The economy is slowing down. They want to tame inflation. But if they tighten a tiny bit too much into a slowdown, risk assets are going to have a problem. And when they do have a problem, they spill over into the real economy. And then also the real economy has a major problem. So what they're trying to do here is they're signaling they want to posture towards being very aggressive to one side of the mandate, which is the inflationary mandate. They want to be seen as very reactive to that at the moment. But at the same time, they have to balance out in a dance, not to basically tighten too much and then hurt risk assets and hurt the real economy. What you said before is important, David. The most important power of central banks is forward guidance, is their talking, is their messaging. Yeah.
When I talk to policymakers in my previous job, they always told me that more than our actions, we want to be able to message to the market what's going to happen. So the tightening hasn't started when it comes to hiking rates, but via their messaging, they have already told so.
This is a very interesting chart that you sent me, and I would have expected, just logically speaking, the inverse of this relationship. You're showing the Fed funds terminal rate versus the U.S. labor force growth 10-year moving average. Now, the Fed funds rate is the orange line on the left-hand side, and the U.S. labor force growth is the blue line on the right-hand side of this chart. And we were just talking about unemployment. Now, I would have thought that a lower Fed funds rate would stimulate the economy more and hence stimulate labor force growth more. But this is obviously not the case. Explain to me why my assumption may be wrong here.
Yeah, because federal funds rate are basically a reactive tool, not a leading tool as many people think. So how it works is the following. The economy very long term is driven in terms of potential growth rates by two things. It's demographics and it's productivity. So how many people are literally entering the labor force? That's the growth of the labor force. And how productive are these people on a year-on-year basis? And how productive is the capital we throw through our economy? And so after the baby boomer birth boom, that brought the labor force to expand in the 70s, in the 80s, at very fast pace. Population growth, David, has come back to its long-term average. Its long-term average, it's only 0.5% on a year-on-year basis. And so as the population doesn't grow much and it ages, the labor force reduces, right? Slows down its growth. So we have less people working. Those people are productive, but the productivity doesn't go up. Potential growth rate come down, and therefore Fed funds rate need to be adjusted downwards too. So Fed funds rate are a reaction. They don't lead, they react.
Well, let's talk about the labor force and demographics. So you're right. I was thinking about unemployment. It's not really the same thing. So the labor force growth has been shrinking over the last 40 years. In particular, the labor force participation rate has been shrinking. Now, we saw sort of an increase in the labor force participation rate after World War II, when more women entered the workforce. It peaked a couple decades ago. Now it's slowly starting to shrink. Why is that?
It's basically shrinking because the population is aging very fast. So if you have
is it accounting for immigrants and younger people entering the workforce? Is that taken into account?
Yes, it does take that into account. And even accounting that, if I look at the United Nations forecast for the US labor supply, so how many people work literally in the US, between 2030 and 2050, this labor supply is going to grow by 0.5% a year. That is it. And that accounts for immigration already, net immigration coming to the US. If we move to Europe or to Canada or to China or to Japan, this labor supply growth year on year is shrinking, David. The labor force is becoming smaller and smaller, while the inactive part of the population, the elderly part of the population, is becoming bigger and bigger. So you then understand that the equilibrium interest rates for this economy to function, not to blow up under the unproductive load of debt we have, are lower and lower and lower. And that's why this chart shows the federal funds rate coming down as the labor growth also comes down.
Well, okay, so it's not a leading indicator, but the Fed funds rate might go up this year. So is that coincident of the labor force participation with the labor force growth rate going up as well, or not really?
Not really. So this year you might have back some of the labor force that basically left the market last year because they had 401k gains, they have house prices gains, all of that, right? So they decide not to participate actively in searching for labor anymore. Some of these guys, you might get them back, but that's not the reason why real rates will go up this year. Real rates will go up this year because we have an inflation problem.
Yeah. Let's talk about real rates in just a bit. Okay, I want to just finish up on this demographic issue because I think it's very interesting. Okay, so you're saying that the labor force growth rate is projected to be, 0.5% in the future for the U.S. What does that mean for GDP? I'm thinking about GDP growth. In order to grow at larger than 0.5%, the productivity of the labor force has to increase year after year, right? Is that going to happen, or are we going to see very low 0.5% GDP growth in the future?
Look, on the macro compass, I have a chart that goes back 700 years for the UK productivity rates. It's not the US, but
hold up. How do they measure productivity 700 years ago? I'm curious.
It's a very good question, but these guys did. There's a paper, and these guys did an amazing job going back all the way through industrial revolutions and trying to apply a coherent framework to measure productivity. Okay. And actually, back then, this is total factor productivity of labor, productivity of capital, and so productivity through centuries was roundabout stable with a slightly declining trend between 0.5% and 2% per year, which means we've become smarter as humanity. We become a little bit more productive, either via our capital or via our labor productivity. Now, this productivity rate for the next century, next decades, is estimated to be around, take it or leave it, 1%, more or less. Which means if your labor supply grows by 0.5% and your productivity grows by 1%, let's say, David, then on a structural trend basis, your real GDP growth is about 1.5%. Okay. And that's it. And that is if real interest rates remain very, very low so that the entire economy can sustain this high level of leverage that we have and we do not implode on our leverage. Because if your GDP growth is growing only at 1.5% and you are levered up to your nose, you need the cost of this leverage to be low in order for the economy to remain in equilibrium.
Yes. Okay. Let's talk about the real interest rate. You said that the real interest rate might rise this year. Is that correct? Well, the real interest rate, just to recap for the audience, is the nominal rate minus the inflation rate. If you're saying that the real interest rate is going to rise this year, well, you're assuming that the nominal rate will rise faster than the rate of inflation. Explain why.
That is correct. So real interest rates are the difference between nominal yields and inflation expectations. If you want to define it, is when people borrow, David, and that's why real interest rates are so important. They pay a nominal coupon on this load of debt, but inflation eats away their debt over the very long term. So what they're really interested in is how much are they paying in real terms, right? After inflation has eaten away their liability costs, they need to pay a coupon on it as well. What is this real cost they need to face, right? So it's expectation about inflation and expectation about nominal yields that drive the real yield definition. And so this year, what I expect is that the Federal Reserve will hike interest rate and signal that they are hiking. Yes. So nominal yields, especially at the front end of the curve, go up. They have already gone up, right? 5-year interest rates are up to 1.5% already, almost 2% in the 5 years. So nominal yields go up. and inflation expectations are not rising anymore. Mm-hmm. Why are they not rising anymore? Because the fiscal stimulus we had in 2020 and 2021, this was gigantic. This was proper money printing. This was money ending up on the bank account of people that they could spend literally in the economy. Mm-hmm. This impulse of fiscal spending is exhausted. The last time checks reached Americans was in March 2021. There's a lot of time between then and now.
I understand your argument about the nominal rates going up. I understand the front end of the curve going up. I don't understand why you think the inflation expectations will not go up as fast. So we are currently in the U.S. 7.5% headline CPI. Are you saying that expectations for inflation are peaking?
Yes, I think so. And I have a chart that actually shows that. So inflation is driven effectively by a larger pool of money chasing a fixed amount of goods. That's how you create inflation. Now, David, the issue is, what is money? And people mess up this term a lot. And so I think that most of the money is credit that gets thrown to the private sector and that the private sector literally can spend on real goods. And do you know who creates this money? Most of this money is created by the governments when they do fiscal deficits. What do? Is they expand their balance sheet and they send resources to you, to me, for us to spend. They either lower our taxes, they send us checks. So we have more spendable power. We have more money, real money that we can spend. The other guys creating these are banks. Every time they lend, banks expand their balance sheet and they give you credit. They give you access to money you didn't have before. I created a metric. It's called the credit impulse.
Yes.
On a G5 basis, this metric is looked after for China, but not so much for the 5 largest economies. I aggregated all of them, calculated credit that goes through the private sector. This metric measures the pace of growth of credit. So how fast are you pumping credit through the economy? The faster you pump it, the more people will have literal money to spend and the more inflationary pressures are going to go up.
This is a key chart here. Let's show this chart right now. G5 credit impulse is a percentage of GDP. And then in the orange line, you have global inflation year over year. Okay, I'm not going to get into the technical details as to why you're choosing to show credit impulse as a percentage of GDP, but basically it shows that there's a strict correlation between these two variables, at least over the past 7 years. And you're showing that there is a huge decline in the G5 credit impulse. Wow, so that must have been due to COVID, right? That must have been due to COVID. If not, I can't. That straight vertical line downwards. What is the cause of that, first and foremost?
Yes,
and then we can talk about inflation.
Let's talk about the credit impulse first. Then we talk about how it relates to inflation, right?
Yes.
So this credit impulse in this chart basically is the pace of growth of credit creation. So it's the acceleration or deceleration in how much money you throw to the private sector, additional money. And the largest contributor to this increase in money creation in 2020, 2021 was indeed, as you said, the COVID response, the fiscal response to the pandemic. So the governments created so much money on a G5 economies aggregate basis. On an accelerating pace, they created so much money and they gave it to the private sector. It reached the private sector balance sheet. And banks as well, they also lent because the governments were guaranteeing the potential losses on these loans. And so this credit impulse, the pace of creation of credit growth was the strongest my series has ever recorded over the last 20 years. And then the problem is that if you do not create additional credit, David, so fast like you did in 2020 and 2021, you can see where I'm going, right? It's decelerating. You might still create some new credit, but at a very slow pace. It's like a car. This measures the acceleration or the deceleration of the car. And so we accelerated big times like a Ferrari in credit creation in 2020, 2021. But now we are decelerating in credit creation big times. There is no new big fiscal stimulus. There is no new big bank lending. And so we have this cliff. For every credit sugar rush, there is always a credit cliff unless the governments continue printing at the same pace and the banks continue lending at the same pace.
So this chart assumes that inflation is not caused by transitory issues such as supply chain and logistical problems and supply chain bottlenecks. It's caused by the credit impulse and how much money is delivered to the private sector. That's correct?
Yes, That is the largest explanatory factor. It's actually the changes in aggregate demand led by the changes in how much credit the private sector has at disposal to use at any point in time. And of course, supply bottlenecks play a role. I'm nobody to say they don't play a role. They did play a role. But now this credit impulse is going down pretty fast, which means that inflation expectation, according to my model, are going to probably slow down pretty aggressively in the second half of this year.
Second half of this year, how much?
Well, the chart says we can go down easily 50 to 100 basis points. So inflation expectation over the very long term are like 2.5% in 10 years. So Americans or the market expects inflation to be between 2.5%, maybe 3% over the next 10 years. And now this chart would show you that on a delta, on a change basis, this inflation expectation will go down by 50 to 100 basis points.
Right. All right. Let's talk about a few other indicators and we'll get onto the assets that I like to discuss with you. You are an expert on fixed income, and you have here a few charts showing what's going on in the fixed income sectors. The first is high yield spreads, and the second is the OIS 5-year to 30-year curve. So let's talk about the high yield spreads first. It's shot up. That's usually a warning sign for risk assets, is it not? How are you interpreting this chart? 5-year junk credit spreads in the U.S. up, 100 basis points over the last year? That's a lot.
Yeah. It's going up by a lot, and it's broken a channel that was very important. So these high yield spreads were more or less trading in a channel for a year. They were very tight. These are junk credit spreads. This is the lowest, almost the lowest rated corporate bonds in America, 5-year tenor. And these are the credit spreads. So they're measured against treasury yields. So how much these junk corporate bonds are yielding above treasury yields, right? And so we've seen this break up. And why have we seen that? Well, Powell in the January press conference was asked a couple of times, are you worried about financial conditions tightening? As you tighten monetary policy and the economy starts to slow down a bit, are you afraid this is going to hit the private sector? This is going to hit credit spreads? And you remember what he said? He said, well, the financial conditions are tightening, but I'm not that afraid. And so what the bond market does, David, in that case, what I used to do when I used to trade that stuff is I'm going to chase you. I'm going to chase the weakest link in the economy, highly levered junk corporates. I'm going to go after them because if you make the cost of borrowing more expensive and the economy is slowing down, then I can't trust these corporates to be able to refinance anymore. So I need to put a higher risk premium. If I want to buy these junk rated bonds, you need to pay me much more than you used to pay me in the past. And so credit spreads go up. And when they go up, these companies cannot refinance that easily in the real economy anymore. And what do? They deleverage, they walk back. So it's a vicious circle. Credit spreads impact as well the real economy with a vicious loop effect.
What does that mean for stocks?
Yeah, well, that means that if those, it's all about the risk spectrum, right? I mean, you start from treasury yields, they're going up. You move to credit spreads, they need to reprice up a bit more as well. The economy is slowing down, real interest rates have gone up as well. So credit spreads go up. What about equities? You're moving down the risk spectrum. So equities will need to reprice as well when it comes to valuations, right? I mean, if your treasury yields are higher and your credit spreads are higher, then on a marginal basis, why would you buy equities if the economy is slowing down and the Federal Reserve is tightening and every other asset class is repriced? Mm-hmm. Also, equities will reprice valuation-wise accordingly.
Okay. What is this chart, the OIS swap curve? What is that?
Yeah. So a lot of people look at treasury yield curves to say whether they've inverted, what does it mean for the economy? Now, the cleanest way to look at yield curve inversions is OIS. OIS stands for overnight index swap. Sounds very difficult. It isn't. It just measures the market expectation for federal funds rate over a certain tenor. So if I say 5-year OIS, I mean the expectation of the market for what federal funds rate will be for the next 5 years. Mm-hmm. If I say 30-year OIS, that's for the next 30 years. So you clean all the pollution that is given by repo, treasury yields. You just look at Fed funds rate and what the market expects is Fed funds rate to be. Yes. And now 5-year OIS against 30-year OIS, it traded negative. In this chart we show was at 7 basis points a few days ago. And over the last trading sessions, this curve inverted, which means that the market expects 5-year federal funds rate to go up, but 30-year OIS, so the federal funds rate to be over the next 30 years, at the same level they are
Okay.
over the next 5 years or lower.
Last time we had an inversion was 2018, but we didn't have a recession right after that.
Yeah.
Right?
So indeed, that's why I talk about sharp economic slowdowns rather than recession.
I see.
So the direction of travel is very clear, David. I mean, if you make the cost of borrowing so expensive for people in the short term, they're
Right.
going to dial back. They're going to dial back, and so we're going to slow down.
But there's no direct correlation between this and equity prices, right? Because back then in 2018, for example, you'll recall that equity prices in the US continued to climb higher until we had COVID. So this is not purely an indication of maybe a slowdown in the economy, but it's not an indication of a equity market collapse. Let's put it that way.
There was quite a hiccup in the fourth quarter of 2018, if you remember. Stock market repriced by 20% basically in December, in a single month. And the reason why, after that, equity market continued to go up, despite the economy did slow down in 2019, you remember that, was the Powell pivot. So Powell, beginning of 2019, went to the wires and said, okay, guys, maybe we exaggerated a bit with this tightening cycle. We're now going to be much more accommodative. Okay. And so much more accommodative means real yields go down, equity valuations go up. And so the equity markets can breathe again. But before that, in Q4 18, the market had quite a problem. 20% drawdown in Q4 2018.
Okay, let's talk about assets now. Gold. Real interest rates are going up. That should be bad for gold or not?
That is correct, but I'm truly impressed by how stable gold has been this year. Actually, it's going up of late. And so real interest rates have already moved up quite markedly since the beginning of the year. And gold has held up its ground extremely well. Now, this might be due to geopolitics, for example, where people look for a safe haven where to park their cash. But generally speaking, why does gold not do well when real interest rates are going up? It's because the marginal cost or marginal return of placing your money in dollar actually goes up, right? Real interest rates are going up. And so your marginal investor in gold will not be as attracted to that asset class as it is normally when real interest rates are going down. Okay. So I'm impressed by gold. It's resilient.
Right. But what is your outlook? What is your outlook for gold?
So my outlook for gold is this would not be the asset class I'm overweight into this year. If real interest rates go up, the marginal return of people investing in dollar rather than in gold will go up for dollar and down for gold.
Stocks and Bitcoin, risk assets won't end it there. What's your outlook on risk assets, including cryptocurrencies?
Well, tough. So I'm short Bitcoin in my portfolio. My positions are available for everybody to see at the Macro Compass. I'm targeting Bitcoin to drop to $26,000. We went almost there at the beginning of the year. Around about 30,000. We didn't hit my target yet. I'm still short, and I think we're going to see quite a drawdown. And the reason is always the same. If you tighten in an economic slowdown, you reduce the marginal risk appetite people have to a very high beta risk asset like Bitcoin is.
You know what is an interesting chart you should do? I don't know if you've done this already, but credit impulse versus Bitcoin price. I wonder if there's a correlation there.
That would look very good, especially if you overlay real interest rates on top. Then you will see that if people have more spendable money and this money is charged negative real rates, they will find ways to channel through risk assets, Bitcoin included.
I'm a macro nerd, so these things interest me. I would be curious to see that chart if ever you make one. Okay, so $26,000 Bitcoin. So what about stocks?
Well, stocks, it depends what sector we're looking at, right? So
okay, let's talk about your favorite and least favorite sectors, and we'll end it there.
So least favorite sector is probably at this stage, small cap, brick and mortar stuff. So the Russell 2000, for instance, I'm short the Russell 2000. Why am I short the Russell 2000? Because these companies need earnings to go up. They need proper economic growth to go up. We're not going to see that. We're seeing a slowdown and the Fed is tightening on top of it. Not where I want to be then. Where do I want to be? You're going to be surprised by that. It's China. I want to be in China.
Yes.
China is pumping credit, has been doing that for already 3 months under the radar. The January credit creation in China, according to my model, was among the strongest in a single month they've ever printed over the last 7 years. So they are reaccelerating the amount of credit that goes through the economy. Xi Jinping has a Politburo meeting in November 2022. He doesn't want to be there with a weak economy. He wants to be there with a strong economy. And so he's starting his credit engine again. And when he does that, I want to be long Chinese equities.
Very good. Okay, so you're long Chinese equities, you're short Bitcoin, and not so overweight gold. Thank you so much for your analysis, Alfonso. I appreciate it. Very thorough discussion. Where can people find out more about your work? Where can people access the Macro Compass?
Yeah, if you go on Substack, you will find me. So themacrocompass.substack.com, or you just Google the Macro Compass and my name, and you will find it.
All right, and we'll put the link in the description down below as well. Thank you so much, Alfonso. Speak to you next time.
My pleasure, David. Thank you.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.